Hey, thanks everyone for tuning in again today for Lunch at the Market. Looks like the most relevant thing we said yesterday wasn't actually about Apple or Verizon or AT&T or Research in Motion. It was our tiny little note telling you that we added to our short Lululemon 65-60 put spreads, which today are just about worthless. What we sold for yesterday for about $1, you can now buy back for about 10 cents. So if you're quick, if you're a trader, if your time frame is extremely short, there is absolutely no reason to wait the rest of the 10 days until options expiration. You can take it off the table now for about a 24-hour turnaround on a 90% plus gain. So hope you caught that. It pays to read every word that we put out, I guess, for those little trades. Okay, a little trade school before we get into today's move. We are primarily sellers of options here at Magnum Opus Financial. We usually do them as a spread, so that way we don't have unlimited downside. If you're just naked short a put, then you have downside all the way from wherever the strike is that you sold short, all the way down to zero, which could be a big loss depending on whether you're selling something in North American Palladium or Netflix. Selling selling a Netflix 160 put leaves you quite a bit of downside. So we like to do them as a spread so we don't blow ourselves up, and it makes things easy. It's got a built-in hedge. Okay, if you're wrong, we do the standard rolling, right? Which means that when you're short the front month, say for instance in Lululemon, we are still short the 65-60 put spreads in January. If the stock went the other way by $5, right, and the stock traded below $65, we can roll down and out to the next month. So for instance, we're short January 65-60. We buy those back and sell the February 60-55, increase the size of our position, and we get to stay profitable. We do this all as part of the same transaction. If your online broker doesn't allow you to do that, consider switching to Trade Monster. You can find a link to Trade Monster on our website under Investor Tools. Go to Investor Education, click on Investor Tools, and you'll see Trade Monster right there at the top left. You can log in through there, open up a free paper trade account, and check it out. But being able to roll your options positions is huge. Okay, so rolling down and out means you're short here in the front month, and then you buy back this and re-short, okay, down and out the next strike down. Okay, if you increase your position size, you can stay profitable and do this for an additional credit. All right. Uh, so what was a $2 cushion on Lululemon with the stock trading at $65 is now a $7 cushion. So we're unlikely to get in trouble before next Friday. And so because of the transaction cost of taking off so many spreads, we will stay short as long as the stock finishes above $65.01. We'll reach 100% of our profit target. Okay, now what to do with today's losers? MCP, Molly Corp, and BVN, that's our Peruvian gold miner. Both of them are pretty ugly. Right now we're long the January 50-55 call spread on MCP, Molly Corp. Okay, the January 50-55 call spread is worth more than the February 50-55 call spread, which usually isn't the case. Usually once you go out another month, the time premium that's built in means that the spread would cost more, not less. But because of the volatility involved in the front month in MCP, we're able to roll our position out to the next month and actually take in a couple $100s. This is fantastic. Gives us more time to stay in the trade, which means more likelihood of being right. And to offset the cost, of course, we sold the 50-45 put spreads in MCP that expire next Friday. As long as MCP stays above $50, then those put spreads that we sold, they're going to help offset the cost of our long position in MCP in those 50-55 call spreads. Okay, so we were long the 50-55 call spread. We rolled that out to the next month. We actually got to take an additional credit. That's how you roll out, as opposed to before we were describing rolling down and out, or say up and out. In this instance, we're just simply rolling out. Another instance in which we did that with is BVN. We're short the 45-40 put spreads that expire in January, and with the stock trading at $43 and only 10 days left, we thought it best to roll out. Smart people like Jim Cramer and Dennis Gartman are very comfortable being long gold, and so as long as we have smart people like that on our side, we'll continue to have some kind of gold position biased towards the long side until those guys say that they're out. Okay, so we were short the 45-40 put spreads in January, and we just simply roll those out to February for an additional credit. Again, because there's more time value out in the next month, Most of the time value has been eliminated. Theta took care of that for us in January, which is referred to as the front month. That's the next expiration coming up. It's called the front month. So we rolled our position out. So we rolled out on MCP. We rolled out on BVN. We are still short LU, and that should just about cover it. Okay, thanks for tuning in again today. Don't forget to manage your options positions. Next week is a huge week. Earnings season is going to get started in full swing. Don't forget JP Morgan reports before the bell on Friday. Next week we'll get a full week of all kinds of earnings, and it's options expiration week, so be prepared for volatility. Don't take your eye off the ticker. Thanks for joining us again today on Lunch of the Market, and we will see you tomorrow.